Hold on to your hats, folks, because Tata Motors just delivered a real head-scratcher. The Indian auto giant reported a steep 22% drop in profit for the third quarter of fiscal year 25. This comes despite a 2.7% uptick in revenue. Investors were clearly caught off guard. Let's dive into the numbers and see what's really driving this unexpected downturn. This kind of profit plunge raises serious questions about Tata Motors' near-term prospects. Is this a temporary blip, or is it a sign of deeper troubles brewing beneath the surface? Buckle up because we're about to break it all down. Before we hit the panic button, let's take a closer look at the good, the bad, and the ugly in Tata Motors' latest earnings report. This report is a mixed bag, offering both glimmers of hope and reasons for concern. By breaking down the numbers, we can better understand the company's current standing and future prospects. On the bright side, revenue inched upwards, showing that demand for their vehicles hasn't completely dried up. This uptick in revenue suggests that despite the economic headwinds, there is still a market for Tata Motors' diverse range of vehicles. The company has managed to maintain a steady stream of customers, which is a positive sign in these challenging times. However, the glaring issue is that profit took a nosedive. This sharp decline in profitability is alarming and raises several questions about the company's cost management and operational efficiency. The drop in profit margins indicates that Tata Motors is struggling to convert its revenue into actual profit, which is a critical concern for any business. This signals a worrying trend of shrinking margins. Shrinking margins can be a sign of increasing costs, pricing pressures, or inefficiencies within the company. It's essential to delve deeper into the factors contributing to this trend to understand the underlying issues. Are raw material costs rising? Is the company facing stiff competition that is forcing it to lower prices? These are some of the questions that need answers. To understand why profits are hurting, we need to dissect the performance of Tata Motors' key segments: Jaguar Land Rover, commercial vehicles, and passenger vehicles. Each of these segments plays a crucial role in the company's overall performance, and their individual successes and struggles can significantly impact the bottom line. Each of these segments faces its own unique set of challenges and opportunities. For instance, Jaguar Land Rover, known for its luxury vehicles, might be grappling with a slowdown in the luxury market. On the other hand, the commercial vehicle segment could be facing issues related to logistics and supply chain disruptions. The passenger vehicle segment might be dealing with changing consumer preferences and economic uncertainties. By examining them individually, we can gain a clearer picture of the forces impacting Tata Motors' overall profitability. This detailed analysis will help us identify the strengths and weaknesses within each segment, providing valuable insights into where the company needs to focus its efforts. Understanding these dynamics is crucial for making informed decisions and strategizing for future growth. So, let's dive deeper into each segment and uncover the story behind the numbers. So, what's really eating into Tata Motors' profits? Let's delve deeper into the various factors that have been contributing to this financial downturn. It's not just one single issue, but a combination of several challenges that the company is facing. The short answer is a combination of factors. These range from global economic conditions to specific industry challenges that have hit the automotive sector particularly hard. The most significant drag came from Jaguar Land Rover, their luxury car division. This segment has been a major part of Tata Motors' portfolio, but it has faced numerous hurdles recently. JLR has been grappling with a slowdown in the crucial Chinese market. China, being one of the largest markets for luxury vehicles, has seen a dip in demand, which has directly impacted JLR's sales figures. Adding to their woes, the global chip shortage continues to disrupt supply chains and drive up costs for automakers worldwide. This shortage has led to production delays and increased expenses, further straining the company's financial health. But JLR isn't the only culprit. The challenges extend beyond just one division. The entire automotive industry is facing unprecedented disruptions. The commercial vehicles segment, a traditional stronghold for Tata Motors, also reported a decline in revenue. This segment has historically been a reliable source of income, but it too has not been immune to the broader economic challenges. However, there's a silver lining here. Margins actually improved in this segment. This indicates that despite the drop in sales, the company has been able to manage its operations more efficiently. This suggests that Tata Motors is managing costs effectively, even in the face of declining sales. Effective cost management can help mitigate some of the financial pressures and provide a foundation for future recovery. In conclusion, Tata Motors is navigating through a complex web of challenges. From global economic uncertainties to specific industry issues like the chip shortage and market slowdowns, the company is facing a multifaceted battle. Yet, their ability to improve margins in certain segments shows resilience and strategic management. The road ahead may be tough, but with effective strategies, Tata Motors can steer through these turbulent times. Let's face it, China has been a goldmine for luxury automakers for years. But lately, the Chinese market has been showing signs of cooling down. This slowdown hit JLR particularly hard. Chinese consumers are becoming more discerning, and competition in the luxury car market is fiercer than ever. To regain its footing, JLR needs to adapt quickly to the changing tastes of Chinese consumers. This means offering fresh and exciting models that can compete with the likes of BMW, Mercedes and Audi. They also need to ramp up their electric vehicle offerings to appeal to the growing number of eco-conscious buyers in China. Section 5. Commercial vehicles revenue down, margins up. The commercial vehicles segment, which includes trucks and buses, has long been a cash cow for Tata Motors. This segment has historically been a significant contributor to the company's overall revenue, providing a steady stream of income that has helped fund other ventures and innovations within the company. The robust demand for commercial vehicles, driven by the need for transportation and logistics solutions, has made this segment a cornerstone of Tata Motors' business model. So, it's concerning to see revenue slip in this area. The decline in revenue is not just a minor blip, it represents a significant challenge for the company. Financial charts and graphs show a clear downward trend. And this has understandably caused concern among business executives and stakeholders. The revenue drop is a reflection of broader economic issues and market dynamics that are beyond the company's immediate control. This decline can be partly attributed to the overall economic slowdown in India. The Indian economy has been facing several headwinds, including slower GDP growth, reduced consumer spending, and a general sense of economic uncertainty. These factors have collectively contributed to a reduction in demand for commercial vehicles, as businesses and consumers alike become more cautious with their spending. When businesses tighten their belts, they tend to postpone big-ticket purchases like trucks. This is a common reaction during economic downturns as companies look to conserve cash and reduce expenditures. Delayed purchase orders and empty dealership lots are clear indicators of this trend. The impact is felt across the supply chain, affecting not just Tata Motors, but also its suppliers and partners. However, the good news is that Tata Motors managed to improve margins in this segment, despite the revenue dip. This achievement is noteworthy because it demonstrates the company's ability to adapt and optimize its operations, even in challenging times. By focusing on efficiency and cost management, Tata Motors has been able to maintain profitability in its commercial vehicles segment. This indicates that they're focusing on selling higher-margin vehicles and keeping a tight lid on costs. The introduction of new high-margin models has helped offset some of the revenue losses. Additionally, the company has implemented various cost-cutting measures, such as streamlining production processes and renegotiating supplier contracts. These strategies have collectively contributed to improved margins. This strategic approach will be crucial for navigating the challenges in the commercial vehicles market. As the market continues to evolve, Tata Motors will need to stay agile and responsive to changing conditions. Ongoing innovation, strategic planning, and a focus on high-margin products will be key to sustaining growth and profitability in the future. The company's ability to adapt and thrive in a competitive and uncertain market environment will ultimately determine its long-term success. Section 6. Passenger vehicles riding the EV wave, but subsidy headwinds persist. Now let's talk about passenger vehicles, the segment that holds immense potential for Tata Motors. This is where we see some real bright spots. Tata has been aggressively expanding its EV lineup and it's paying off. They've emerged as a leader in the Indian EV market. However, the Indian government recently phased out subsidies for electric vehicles. This move is expected to impact EV sales in the short term. Despite this hurdle, Tata Motors remains committed to its EV strategy. They're betting big on the long-term growth potential of the EV market in India. Section 7. Market reacts. Why the optimism, despite the earnings miss? Here's where things get interesting. Despite the disappointing earnings report, Tata Motors stock actually went up after the announcement. Now that might seem counterintuitive, right? But there's a method to the market's madness. Investors seem to be focusing on the positives. They're encouraged by Tata Motors' strong performance in the passenger vehicle segment, particularly their EV success. The market also seems to believe that the challenges faced by JLR and the commercial vehicles segment are temporary, and that Tata Motors has the right strategies in place to overcome them. Section 8. Tata Motors road ahead. Navigating opportunities and risks. Looking ahead, Tata Motors faces a road paved with both opportunities and risks. On the positive side, India's growing middle class and the government's push for infrastructure development bode well for the auto industry as a whole. Tata Motors, with its strong brand recognition and wide dealership network, is well positioned to capitalize on this growth. However, risks remain. The global economic slowdown, geopolitical uncertainties, and the ever-present threat of supply chain disruptions could all impact Tata Motors' performance. In addition, the competitive landscape in the EV market is heating up, both domestically and globally. Section 9. The verdict to buy, hold, or sell. So, the million-dollar question: should you buy, hold, or sell Tata Motors stock? Well, the answer isn't so simple. It depends on your risk tolerance and investment horizon. If you're a long-term investor who believes in Tata Motors' growth story and its ability to overcome short-term challenges, then holding onto your shares or even considering buying more might make sense. If you're more risk-averse, you might want to wait on the sidelines and see how things play out over the next few quarters. And if you're looking for quick profits, Tata Motors might not be the right stock for you right now.